And in banking, we are on chapter 14. 14 is looking at what? The loan pricing and loan diversification. Loan pricing and diversification. So what is loan pricing? What is what are the factors that affect loan pricing? So when I dealing with loan pricing, we are looking at the interest rates and the terms that financial institutions will apply to loans based on a number of factors. So these are the elements that will determine how the borrower ultimately will pay for the loan, depending on the various issues that the lender will give, starting from the loan product and the associated risks that are involved. So loan pricing involves a number of factors. So number one, the factor that affects loan pricing is the cost of funds, the risk premium, administrative costs, regulatory requirements, and profit margins. So as explained, the cost of funds is basically one of the most primary factors that will determine the loan prices. So here the cost of funds refers to the interest rates that the financial institution pays to acquire the loan it lends out. So these costs will include the interest rates on the deposits, the borrowings from other institutions in other forms, because for them to give you that money, they could have borrowed from banks, they could have borrowed also from the central bank. The other factor is what? The risk premium. So risk premium is simply the additional charge that is added to a loan to compensate the risk associated with lending. We know there's a default risk that is associated with lending. The other are administrative costs, which encompass what? Expenses like processing, underwriting, servicing of the loans. Regulatory requirements, like the statutory requirements of reserve ratio or capital adequacy standards. All those influence what? The pricing of a loan. The profit margin, the amount that a financial institution aims to earn from each loan transaction. That is a profit margin. Okay. So loan diversification. What is loan diversification? It refers to the practice of spreading lending activities across sectors of industries, the types of borrowers, the types of loans in order of risk to improve what? Financial stability. So it's a strategy that banks employ when they want to manage their credit portfolios. So there are key benefits of diversifying a loan. Number one, it reduces what? Concentration of risk. So concentration of risk will occur when the bank's loan portfolio is heavily centered on one industry or one sector. If there's an unsystematic risk that will come in that kind, it will harm. So some of the um, institutions close down. The other determinant is a spread uh, across the various sectors. So diversification will help the spread of the bank's exposure to different sectors. So each sector has different kinds of risks that are associated. Also, we look at the financial stability. So loan diversification will also contribute to overall financial stability. Okay. And it also improve risk management. So by diversifying, a loan can better manage the risks in um, different activities and sectors. It also increases out the profit opportunities. So diversifying the loan can also open up what? New opportunities for profit. Okay. Then we go to chapter 15, which looks at funds, loan of funds theory. I think we talked about this previous lecture. So the basic premise that we have when we're dealing with loanable funds theory is that interest rates will suggest that interest rates are determined by supply and demand of loans. So this theory actually stipulates that the amount of funds available for lending and amounts available for leisure to the borrowers will determine what prevailing interest rates will be there. So there is an equilibrium that um, is arrived at in terms of cost of borrowing and the return of savings. So according to this theory, it says if there's a high demand for funds, there'll be low supply, so it will push interest rates upwards. Whereas if we have low demand for funds and high supply, the interest rates will be what? Will be low. So this theory is important because it assumes that financial markets are competitive and that the interest rates will adjust in a clear market on its own. So what are some of the sources of funds? The supply for funds comes from different sources. We have households, government budgets, surpluses. So these are obvious sources of funds. Households, they contribute a big chunk of supply of loanable funds through savings when individuals take part of their money to the banks, right? So the higher level of savings in the economy come from the households. Government also runs a budget surplus. When the surplus, it means the revenues will exceed the expenditure. So the surplus is used to provide what? Funds that are loanable to the market. So government may issue bonds and the proceeds from these bonds will contribute to a pool of funds available for lending. Foreign investments. So when foreigners come here, they contribute to the supply of loanable funds. So this includes the foreign direct investment and foreign portfolio investments. And when the foreign investors or countries lend money or make investments in our country, they will increase the supply of funds available for what? For borrowing. So what are some of the uses of loanable funds? Who are the users of these loanable funds? So we have many users. We have business entities, government deficits, and consumer credit. So business investments, uh, when the demand for loanable funds actually comes in from the borrowers who require this for various purposes. So the key users of these funds include business investments. So these are the major users of loanable funds. Companies who borrow to finance capital projects and expansion projects, research and development. Government deficits also is another significant user of loanable funds, especially when they want to run their budget deficits. So the budget deficit will occur when the expenditure will exceed its revenues. So they'll be forced to do what? To borrow. When they borrow, government will use um, bonds issuance to purchase um, to make funds available for infrastructure development. The others are um, okay. So these are the two main. Consumer credit also is another source, right? Then we go to factors shifting. Factors are affecting the supply or demand of funds. So what are some of the factors affecting demand and supply of funds? So we have the following factors. So we need to understand that supply and demand for renewable funds is not static. Okay, it's a shift due to various reasons. So some of the factors that we have changes in income levels. So income levels will directly influence the amount of funds available for saving and subsequently the supply for renewable funds. Also, the other factor is what? Fiscal policies. Okay, the inflation expectations, technological innovations, all these are okay. About the network. Are you still able to hear me? So looking at the factors that affect supply and demand. So we also have fiscal policies, include government policies, particularly those related to taxation and government spending. So this will affect the supply of lendable funds. For instance, if government enacts policies that will add incentives to savings, like tax advantages for saving accounts, individuals will more likely want to save. So it will affect what? The saving propensity. Inflation expectations. So sometimes these play an important role in supply of loanable funds. So when people expect inflation to rise in future, what will they do? They will likely save and invest money in ways that can preserve its value. So this can increase the supply of loanable funds. So also technological innovations in the financial sector can also make savings and investing more efficient and lending to increase the supply of loanable funds. Okay. So we go to chapter 15, where we're going to look at a money supply and the monetary policy. Money supply and the monetary policy. Okay, over and over, we've talked about money supply, which refers to the total amount of money in circulation. So it is a concept of monetary economics, which depends on inflation and interest rates. So there are categories that will help banks and policymakers monitor decisions on the monetary policy. So the main categories of money supply, we have M0, which is a monetary base. This refers to the currency in circulation. So it includes coins and paper money. M0. Okay. So M0 does not include deposits in other forms of money. Then we have M1. What does M1 include? M1, what does it include? So M1 includes MO plus the demand deposits. So it includes checking accounts. These are funds that can be accessed immediately for transactions such as withdrawing cash from ATMs or checks. So M1 represents the most liquid form of money and is a key measure to track shorter economic activities. And we have M2, which includes M1 plus saving accounts. So it also includes time deposits and certificates of deposits. So the money market funds, we use these. So they are slightly less liquid than M1, but they are easily converted into cash. We also have M3. What is included in M3? M3 has M2 plus larger time deposits and institutional money. So these are less liquid. Typically, they involve large institutional investors. So what is meant by a monetary base? Are we together on understanding these um, amounts of money that we have? Any questions so far? So we go to monetary policy. So monetary policy refers to the action taken by a country's central bank to regulate the money supply and influence what? The economy. The central bank uses monetary policy to achieve various objectives, including controlling inflation and promoting economic growth. So monetary policy can both be expansionary and contractionary. Remember, what did we say about expansionary policy? It's a policy that aims to increase the money supply in the economy. How? By lowering the interest rates, by encouraging borrowing and spending. So this one is used in periods of economic what? Downtimes or recessions. And the expansionary, contractionary monetary policy is used when they want to reduce the money supply in the economy. So this is by increasing the interest rates and reducing the availability of credit. So what types of monetary policy tools do we have? So we have OMO system, which involves buying and selling of government bonds. We have discount rate, which is a rate that is charged by central bank to commercial banks for borrowing funds. We have reserve requirements. So requirements refer to the percentage of deposits for commercial banks that are required to hold reserves. Okay, a certain percentage of their minimum balance. So we go to chapter 16, financial markets and instruments. So the capital markets are for long term and money markets are for short term. Then foreign exchange market, this is for buying and selling currencies. And derivative markets, it's used for trading instruments derived from the underlying what assets. And financial instruments. So we have equity instruments which represent what? Ownership in companies. We have debt instruments which represent borrowing, like bonds and treasury bills. We have derivatives. These are contracts whose value depends on the price of an underlying asset. Then we have money market instruments. These are short-term instruments like treasury bills and repurchase agreements. Okay, so we also have government debt and fiscal policy. So when government borrows money, typically through issuance of bonds and treasury bills, they may either be having an internal debt, which is borrowing from the domestic economy, and external debt, borrowing from other countries. They also use fiscal policy, which is a way in which government makes decisions about spending and taxation to influence the economy. So they use an expansionary policy where government increases spending or tax cuts to stimulate the economy, and contractionary fiscal policy, which government uses to govern spending and taxes by reducing what? Which reduces inflation. So we have what is called a fiscal deficit, which occurs when government expenditures exceed revenues. Corporate finance. Corporate finance, we're looking at corporate finance goals. Basically, in a nation, they're to maximize shareholder wealth. So the primary goal is to increase what the value of a company's shares over time and optimal capital structure. We're looking at balancing debt and equity. So capital budgeting is a process that is used to evaluate the potential investments or projects that determine profitability. So we have net present value, which is the difference between the present cash flows and the outflows. Then IRR is a discount rate that makes NPV zero. Payback period looks at the period within which you are going to recover your initial investment. Okay, so now I think we've covered most of these are recurring that we have done already. So now we go to our test quickly. We'll look at some of the questions that came. So it was how many minutes, an hour's test that was supposed to be done. Okay, question number 1. Reads, which of the following is a step that the central bank will take to encourage greater investment in an economy? It will increase reserve ratio, it will reduce the cash reserve ratio, it will increase the bank rate, it will look to sell the government securities in the open market. So which one is our answer there? We talked about this. Question number 1, which of the following is a step that the answer is B, it will reduce the cash reserve ratio so there's enough money in circulation. Which of the following is a step the central bank will take to increase the overall availability of credit? The answer is also B, to buy more securities from the market. Okay? It will buy, by buying, what does it mean? Selling, it means it's absorbing. Buying, it means it's releasing money in the economy. Which of the following statements represents a main function of the central bank?
Sorry, Collins.
Uh-huh.
On question number 1, how did you explain the answer?
Question number 1. What was the explanation that I gave?
Yes, like when you pick the answer, like more like explaining what that means.
Okay, so we took on B to reduce the reserve ratio because I said the reserve ratio is a proportion of the minimum balance that a commercial bank must have. Okay, so if they lower the reserve ratio, they'll allow commercial banks to breathe more. So they'll give more money, encouraging investment in the economy.
Okay, thank you.
The second one, we said, which one of the following is a step that the central bank will take to increase overall availability of credit? We said B, buying more securities from the market. Because when the central bank buys securities, it will inject money into the system. So it will increase the availability of what? Credit. All right. Are we following?
Yeah.
Okay. Then question number 3. Which one of the following represents the main function of money? 3, which one represents the main function of money? Responsible for regulation of supply, which is correct. Responsible for issuance of coins, correct. It acts as both a banker to government and other banks in the country. So all of them are correct. Okay. Number 4.
Yeah, moving too fast. I didn't even hear that question.
Question number 3. Which one represents the main function of the central bank? Number 1.
Oh, okay. All
Responsible.
right. I thought you said money, so I got confused. Please carry on.
Okay, so we'll just do 10 questions. I've answered all these in the question and answer booklet. I'm supposed to have a class with the research group. They are busy calling me. Okay. So question number 4, which one of the following is a bank liability? Customer loans, lease finance, bills receivable, certificate of deposits. Which one of the following is a bank liability? So certificate of deposit is a bank liability. Why? Because it is a time deposit that is held by a bank that represents a liability. Because the bank will owe the depositor the principal plus interest when the CD matures. Okay, number 5, assume over the last 1 year, inflation was 10% and banks are quoting nominal interest of 25%. Using Fisher's equation, calculate the real interest rate. Remember the formula for Fisher's real interest? Huh? 1 plus nominal
Yes.
rate over
Formula for real interest rate, yes.
interest, inflation rate minus 1. Okay, so we're going to have 1 plus what? The 25%, which is 0.25 over 1 plus the real interest rate, which is 10%. So what are we going to do? If you have a calculator, what are we getting? The formula is 1 plus 25%, which is 0.25, divided by 1 plus inflation rate, which is 1.1, and minus 1 times 100. What are we getting? 18.64. Okay. So the following statements is true about demand deposits. Which of the statements is true about demand deposits? A, it includes both fixed deposits and current deposits. B, it includes both savings deposits and fixed deposits. C, it includes both current and saving deposits. And D, it includes fixed, current, and savings. I think it's C. It includes current and savings deposits. Okay. So the explanation is that demand deposits are funds that are deposited in the bank that can be withdrawn without notice. So these will include both the current and savings accounts. Okay. So we'll end here. Thank you so much for your time.